On March 9, 2023, the stock of Silicon Valley Bank plunged more than 60% in a single trading day, wiping out billions of market value and signaling the end of an era for the tech industry's most trusted financial partner. The bank that once seemed invincible, founded in a garage in Palo Alto, championing startups from the dot-com boom to the AI renaissance, collapsed in less than 48 hours, leaving venture capitalists, founders, and regulators scrambling to comprehend how a pillar of innovation could crumble so suddenly. Founded in 1983 by Bill Biggerstaff and Robert Medeiros, Silicon Valley Bank, or SVB, grew out of a simple idea: to provide banks with the kind of flexible financing that startups desperately need, something the big Wall Street institutions refused to offer. In its early days, the bank's modest loan books were filled with fledgling software firms that would later become household names. Apple, Cisco, and Intel all walked through its doors. As the tech sector exploded, so did SVB's balance sheet. By the 2000s, the bank had become the de facto financial hub of Silicon Valley, known for its willingness to lend against intangible assets like intellectual property and future revenue streams. The rise was meteoric. In the decade leading up to 2020, SVB's deposits swelled from a few $100 million to more than $180 billion, a staggering growth rate that outpaced even the most aggressive banks. Its clientele expanded beyond startups to include venture capital firms, crypto companies, and even non-tech giants looking for a foothold in the innovation economy. The bank's culture, a blend of Wall Street rigor and garage startup daring, attracted a new generation of bankers who spoke in terms of runway and burn rate. Investors praised SVB as a barometer of tech health. Its quarterly earnings became a must-watch event for anyone tracking the sector. Yet beneath the glossy surface, warning signs began to gather. First, the bank's asset composition grew increasingly lopsided. Over 90% of its deposits came from a handful of high-growth companies that routinely pumped massive cash flows into the bank during funding rounds, only to withdraw those funds when the next round closed. This created a fragile liquidity profile, one that relied on a steady stream of new capital to stay afloat. Second, SVB's investment strategy leaned heavily into long-dated, fixed-rate U.S. Treasury and mortgage-backed securities. When interest rates were historically low, these securities seemed safe. But as the Federal Reserve began hiking rates to combat inflation in 2022, the market value of those bonds plummeted. The bank's balance sheet was now a ticking time bomb. Rising rates meant that the securities it held were losing value faster than it could replace the cash flowing out. The third warning came from the venture capital community itself. By late 2022, venture firms were reporting longer funding cycles and lower valuations, a stark reversal from the money printer era of 2020-21. Startups, once flush with cash, began tightening belts, cutting staff, and, crucially, drawing down their deposits to cover operating expenses. The same institutions that had once deposited tens of millions each month were now withdrawing at an unprecedented rate. Internally, SVB's risk management team flagged the growing concentration risk, but the bank's leadership, confident in its unique relationship with the tech ecosystem, downplayed the concerns, believing that the unprecedented nature of the crisis would never repeat itself. The collapse unfolded with the speed of a flash crash. On March 8, 2023, a single tweet from a prominent venture capitalist hinted at a potential liquidity squeeze, sparking nervousness across the sector. Within hours, dozens of startups began pulling funds, and a cascade of withdrawal requests surged through SVB's systems. The bank's Treasury Department scrambled to sell its bond holdings to raise cash, but the market had already adjusted to the higher rate environment, forcing SVB to accept steep losses. By the close of business, the bank's liquidity ratio had fallen below regulatory thresholds, and the Federal Deposit Insurance Corporation, FDIC, stepped in, taking control of the institution to protect depositors. The immediate aftermath rippled far beyond the bank's doors. Over 2,000 startups faced the prospect of frozen accounts, delayed payrolls, and halted product launches. Venture capital firms, anxious to preserve their own portfolios, rushed to coordinate with the FDIC, urging the regulator to find a buyer for SVB's loan portfolio and to ensure that depositors could access their funds quickly. Within 24 hours, a consortium of larger banks announced a deal to acquire SVB's deposits and loan book, a move that stabilized the market but left many founders wary of a new, less familiar lender. Regulators, meanwhile, launched a post-mortem that exposed gaps in oversight. The Federal Reserve's supervisory framework for mid-sized banks, which had been relaxed in the years after the 2008 crisis, proved insufficient to catch the systemic risk that SVB's unique business model posed. Critics argued that the too big to fail lens had blinded policymakers to the danger of too specialized to fail, a bank whose concentration in a single industry made it vulnerable to sector-wide shocks. In the weeks that followed, Congress held hearings where CEOs of major banks testified about the need for tighter liquidity requirements, while lawmakers drafted legislation to broaden stress testing criteria to include concentration risk. For the tech ecosystem, the collapse served as a harsh reality check. Startups, once lulled by abundant capital, began rethinking their cash management strategies, diversifying banking relationships, and building larger cash reserves to survive future market turbulence. Subscribe to The Collapse for more stories like this.